Welcome to Rebank, your front row seat to the future of finance. Adrian and Seb, welcome to Rebank.
Hey, well,
love to be here.
Well, it's great to connect with you guys. I think the timing of this conversation couldn't be better. There's been a lot of emphasis recently on vaults at the highest level and relatedly vault curation. I've had a lot of conversations recently around the future of asset management and where this new kind of tokenization stack fits into that. And you guys are, I think, far and away the leaders in the space when it comes to vault curation from a very DeFi-native background. Maybe to kick off, the starting point needs to be, tell us about Steakhouse. What is Steakhouse Financial? I feel like if I go around and ask 5 different people in our industry, what is Steakhouse? They would probably give me 5 different answers.
Steakhouse is today an internet native asset manager. I think that's the easiest way to think about it. And what we mean by internet native asset manager is it's not the same thing as a traditional asset manager. What we do is we focus on building products for stablecoins that have very strong non-custodiality guarantees. And we offer these as viable alternatives in a product space and an economy that we view as generally stablecoinizing. So in some sense, you can think of us as a fintech if you want. We take the view that the economy is stablecoinizing rapidly, and we are building products to cater to a new market structure that will have stablecoins as one of the foundational elements of that. But of course, we started off as a pure DeFi native company, as a DAO advisory and services company as contributors to MakerDAO. First as individuals, so Seb can speak about his experience at Maker for years in different core units, working on the sort of frontier of real world finance and tokenizing assets and doing off-chain investing. And since then, we've stumbled upon this business model that allows us to put our ideas into practice and all of the learnings and the background that we bring, put it to work in a very DeFi native context to a great success, as it turns out. So from individual contributors to consulting to internet native asset manager and leader in the space.
Yeah. Seb, anything to add to that and or anything on your background you'd like to share?
No, yeah, we just echo what Adrian just said. We have our hosts at MakerDAO creating the first core unit, working on financial statement for DeFi protocol when it was something completely crazy to say that DeFi protocol was mainly a balance sheet, which I guess more financial people would agree now. We were also innovating in the real asset space. It's still only the beginning of tokenized securities and all this good stuff. But now we are the leading curator in the vault space, and the vault are the hot topic those days. So that's great to be here.
Yeah. Perfect. Well, you certainly are the leading curators. I think you manage something like 4 billion AUM across a range of different platforms, Morpho, Cachinero, maybe others. Do you want to talk high level about your activities in the vault and vault curation space?
Certainly. So to summarize it, we have today 4 billion in assets under our different mandates. Roughly half is what we think of as an asset liability management mandate, where we're developing the Grove protocol on behalf of the Sky ecosystem. And Sky is obviously the decentralized stablecoin that's using this concept of stars as a way of creating a dynamic market in asset allocation, where the mandate is very constrained and must very strictly follow the rules of the Atlas and the governance processes of Sky. In the vault space, we're more unconstrained and we are free to sort of develop the products that we want to develop. And what we aim to do is build foundational credit layers, starting with what we consider it to be a prime repo market as a way of channeling the risk-free rate of DeFi, followed by higher risk tiers of products like high yield collateral and other types of opportunities. And I think it's really in the prime space that you've seen the most institutional interest for now. So most of our users, out of the 2 billion, I would say a substantial majority comes from institutional integrations or large users. These can be, ranging from hedge funds to individual LPs, but mostly, frankly, fintechs, custodians, and exchanges that work with us to develop an earning product for their stablecoin platforms. I think for the most part, there is a lot of interest from the perspective of a custodian that says, I have a lot of stablecoins on platform, and accessing DeFi is an interesting way of getting the stablecoins to kind of stay on platform. The more thoughtful integrations, I think, really take the non-custodiality element to its logical conclusion. And here, I think our partnership with Coinbase, where we're the exclusive provider of these solutions, really shines, because Coinbase has been extremely thoughtful about its non-custodiality and aspect of its product. So first of all, users actually experience DeFi just channel through the user experience of Coinbase. And secondly, they also integrate the borrow side as well as the lending side of the repo market. So users that have crypto collateral on exchange on platform are able to borrow stablecoins against it. And users with stablecoins are able to lend stablecoins against it, and all of it in a sort of DeFi venue.
Can you maybe turn that specific integration into a tangible example? So you partnered with Coinbase, and you're now delivering to Coinbase users in the Coinbase app the ability to basically earn yield on stablecoins by investing in strategies that you manage. Can you just kind of tangibly break down exactly how that works, and then what the strategies are, how you manage them, and then how the yield is ultimately kind of safely and consistently generated back to users?
Yeah, sure, I can take this one. So Coinbase started by allowing users to use a CBBTC, so their BTC representation on the Bain network, as collateral for people to borrow USDC, so the US dollar stablecoin issued by Circle. That created a lot of activity in Bain, and the second step, the idea was to provide to their users within the Coinbase application, without going outside, a self-custodial wallet where people could lend USDC into the Steakhouse vault. So this is fully non-custodial, yet remain in the Coinbase application, but it's still fully non-custodial. So when people deposit USDC in the Steakhouse vault, it's used to serve as loan against crypto collateral, which are CBBTC, so the BTC representation, wrapped ETH, so Ethereum, and a few others that are on the same quality. So it's really prime product, as we call it, as I mentioned. We have high yield product and prime product. This is a prime product, trying to achieve a rate just a bit north of SOFR, or the TradFi repo market rate, which is quite liquid. That was also a key constraint for our users, because obviously if you are depositing into a vault, you want to be able to take your money back as you want. And then the key concept of a vault is really on the non-custodiality. And Coinbase picked Steakhouse because we are pushing this concept to the limit. For instance, once a user deposit money into USDC into a Steakhouse vault, he owns the right to usually veto, there is a veto on the decision we make. For instance, we cannot add a new collateral without having something that we call in the vault space the guardian, being able for this vault, it's 7 days. For 7 days, the guardian can veto the decision to add a new collateral. Because obviously, when you are a creator, you can change the mandate of the vault to a new kind of assets, which might be risky. And so in this example, before we can add a new collateral, there is a 7-day time lock during which the guardian can veto the decision. So that's protect all the depositor into the vault. And that's different with more or less with TradFi, because in TradFi, well, your money is at a custodian, so it's non-custodial, and you cannot control what is done with the money.
And that's really coming back to the topic of vaults and why it's attracting so much attention. We think that this is a transformational trend for the finance industry as a whole. So for us, non-custodiality is a very, very strong value proposition, and frankly, one of the few, if not only, reasons anyone would use these products as opposed to using a traditional financial product like an ETF. Like, to get SOFR, there's already a million ways to do it for Coinbase users. They don't need, strictly speaking, Coinbase to do that. And Coinbase could indeed offer ETFs to their customers. The benefit of a vault is that you are able to essentially offer a product that can make stronger and stricter risk and transparency guarantees relative to a traditional product. So by using the Steakhouse Vault, there's full exposure into what the curator is doing, full exposure into the liquidity of the underlying strategy. And in theory, this can also scale a lot higher and a lot faster than even traditional ETFs, which have proven to be very scalable as a finance instrument. And in parallel to sort of the ETFs. So I don't actually think this is as outlandish as it sounds, because the asset management industry has actually seen transformations of this scale, or what we expect the vaults to be, the scale that we expect vaults to reach. Because the ETFs are essentially an example of how aggregation, simplification, greater access, lower fees can create a very compelling product that can essentially outcompete mutual funds, which were the prior incumbent, and grow significantly faster. And, you have companies that make their entire business around ETFs nowadays. And we view vaults as, to a degree, competitive, but largely complementary product in relation to ETFs that simply offers a different value proposition. And certainly in a world where, more people are native to stablecoins, it'll be the first and most obvious use of those stablecoins rather than, off-ramping them into an ETF.
Yeah. So to just dig a little bit deeper on the non-custodial nature of it. So you mentioned a couple different things. One is that in a sense, investment mandate is, it sounds like, enforced by presumably smart contract logic. Like there are only, let's say in the case of effectively a lending strategy, a collateralized lending strategy, you're willing to accept certain collateral types, and presumably there's some LTV capping the amount of lending that any specific collateral can have. And maybe there's even like some sort of concentration requirement around different collateral types in the broader pool. Firstly, did I characterize that correctly? Are those examples of portfolio management requirements that a vault might have? And in that example, would those requirements likely be actually coded into smart contract logic, or would the curator have the discretion to manage the strategy, under kind of a broader mandate?
No, yes, that's fully correct. As you mentioned, for instance, for the Coinbase Vault, it is the so-called Coinbase Vault, the Steakhouse Vault, where Coinbase users are depositing. It's a Morpho V1 vault, so it can only lend on Morpho. So USDC that is deposited currently against 4 collateral, which are having a limit to how much each collateral can represent in terms of borrow activity. And the LTV, so the loan to value, which in most cases is 86%, in one case is 77%. So this is hard coding, and there is nothing we can do to bypass those hard coding. In the Morpho V2, there is a transition which add more feature. There is concentration risk as well. You can limit the exposure to a given collateral in percentage of the portfolio.
And how about then the almost like second element of this? I mean, using a TradFi analogy, like you would have probably a concept of a fiduciary responsibility. So, you would be basically entrusting your assets to an investment manager who would effectively be custodying those and then kind of investing them, managing them on your behalf, and have a legal responsibility to, ultimately meet the investment, like align with the investment strategy and return the funds to you at some point. Is there a similar concept here, or is the non-custodial nature of it such that the assets are not actually yours at any given point in time, can't be withdrawn by you perhaps? Maybe you have kind of like admin rights to, set certain variables or like enact within the construct of the smart contract logic certain actions, but without being able to withdraw the funds.
I think here, like, we make the distinction between cryptographic guarantees and let's call them social guarantees, where something like a fiduciary responsibility is a legal construct that's meant to enforce a social guarantee, in the sense that an asset manager needs to have the threat of legal action in order to persuade him to not behave maliciously, let's say. And in the DeFi space, one of the value propositions is that you can actually not necessarily do away with fiduciary responsibility, but enforce it cryptographically in enough variables to make it actually impossible for the curator to be malicious. Now, there's a lot of room around, and there's a lot of room and nuance in the vault space, because there are a lot of vault constructs that have hidden social guarantees that look like cryptographic guarantees. They have a lot of admin keys, as you mentioned. One of the reasons we like the Morpho platform is because so much is actually cryptographically guaranteed. That said, there is still a lot of discretion on the curator side which is why we also go the extra mile to try and turn as many of these social guarantees as we can into cryptographic guarantees. The Guardian mechanism that Seb mentioned is an example. There's really nothing that we can do again if a Guardian vetoes a collateral onboarding decision that we make. And so essentially what that leaves is the distinction of a Steakhouse vault as opposed to any other curator or most other vault platforms is that we try to keep the only social guarantee to be essentially the brand promise, that we won't actually try to onboard random collateral into a strategy that a prime vault will always be a prime vault. And if we break that promise, then users will leave, and there's very little or nothing that we would be able to do to prevent that. And I think this use of cryptographic guarantees as a key pillar is crucial to the value proposition. Anytime, you make a shortcut around it, you invite the discussion of like, okay, so perhaps this needs some kind of a legal framework or fiduciary responsibility or obligation around it from the curator's perspective. It's not necessarily that we shy away from it. It's more that our view is that in order for a DeFi product to be successful, it needs to be able to make these strong, mathematically enforced guarantees to the user if it wants to be competitive with a traditional financial product. And that's why it's so important to really focus on the details and look into how these vaults are set up. The Guardian is one example, a time lock is another. And you see, with the credit crunch in October and November, you see examples of how, when there's too much leeway in the social guarantee side, things can go wrong for users, even in something that should presumably be quite low risk, which is, repo lending market against, crypto collateral. And so I think that that's where our focus is in making as much of it as cryptographically secure as possible and leaving as little as possible to the social layer, where the only remaining piece left in the social layer is essentially our ability to deliver on the brand promise and to accrue that brand value over time by, winning the trust of the user.
Yeah. I really like the way you guys think about that. I mean, you can kind of track back through various eras of crypto kind of from the beginning and point to very strong kind of philosophical motivations for doing various things around decentralization and code is law type things. And I think they have at times created meaningful value for real people in various parts of the world. But it's also easy to point to a variety of different concepts which have kind of remained in the philosophical, and frankly, aren't really moving the needle in terms of tangible value creation for day-to-day people. And I think that includes around finance. There were a lot of efforts to say, hey, we're going to make a better dollar so you don't get rugged by your government. And maybe over some time frame that's actually true. I mean, I think you can make a lot of arguments about kind of debasement of the U.S. dollar right now, for instance. But by and large, that is not currently one of the burning platform pain points around the financial system. But I think the way that you guys are applying this sort of basically code is law design to investment management in a way that undeniably improves the quality of the product, is a very tangible implementation of not only a lot of the philosophy, but the technology that's been built to deliver that philosophy and really drive it in a way where it's scaling now against real world problems. I wonder if you have any reflections on that. I mean, I guess one, do you agree? And then secondly, do you think that in any way is the excitement around the vault opportunity and the evolution of asset management motivated by that?
No, yeah, I would completely agree. I think maybe sometimes we lose the nuance. And I would agree there is some part of DeFi that wants to remain true to the core tenets of crypto, like using only fully decentralized collateral, which is only ETH, on Ethereum. There is not that much. We see it a bit differently. What we are trying to do is removing counterparty risk, but not all counterparty risk. We want user of our vault to have no counterparty risk on Steakhouse. But it doesn't mean they have no counterparty risk. If they are using USDC to put it in the vault, they have a counterparty risk on Circle, obviously. If the vault is landing against CBBTC, that's issued by Coinbase. So there is a counterparty risk on Coinbase. But as you can see here, we are keeping some public and regulated actors, and we are removing Steakhouse, the startup, from the equation. There is no counterparty risk here. And that allows you to create open innovation, composability between highly reputable actors that might be not able to move fast enough to track innovation, and let more startup or more innovative companies try to do things without creating the counterparty risk on them.
And it's like, I don't actually think that we've lost them. Like, to me, the Vault construct really embodies a lot of the things that people were describing. Like, the way that early proponents of DeFi were describing the values of DeFi are less around decentralization as a collection of knickknacks and gadgets to abstract the need for banks. Because frankly, like, Bitcoin and ETH do that. So if you really want to remove your counterparty exposure to the dollar system, you should hold ETH and Bitcoin and use it. And that alternative exists. One of the co-founders of Maker, now Sky, like Nikolai Mushegian, had like this list of values, and like one of them was incentives are like gravity. They're a natural law, right? And I think that DeFi is a really good way of creating systems of incentives that allow participants to meet each other and to be able to do that without having to know each other, sign legal agreements or anything. Because essentially the fundamental tenets of their interactions are designed, agreed upon, executed, and enforced in the same transaction. And I think we view the vaults as like an encapsulation of this. Like, really, smart contracts is a clunky term for a script that runs on a blockchain, but it's kind of what it ends up looking like. It's an agreement between two parties that meet each other and they agree to a set of rules. The space for the creation of new rules is very broad. You can choose to use the rules of Morpho. You can choose to use the rules of Euler or Ade or whatever. So the switching cost between different rule sets is very low. And that allows for far more competition and innovation to allow the best rule sets to emerge, or to allow for rule sets for specific types of use cases. For us, this aspect of decentralization is really core to the Vault idea. And it's just a way of encoding and channeling incentives that allows people to meet with the lowest possible risk.
Seb, maybe a question for you. So, I'm familiar with your background at MakerDAO, now Sky. A lot of what USDS, the Sky stablecoin, does is basically fully automated, almost collateralized lending, like collateralized minting against eligible reserve assets. How do you view the work of Vault Curation vis-a-vis that model, which now has a track record in DeFi? Like, what are the advantages? How does it represent a sort of evolution, perhaps, of that strategy? And maybe to some extent, what are the trade-offs?
Yeah, sure. So you correctly pointed out that USDS is quite decentralized. I think it's the biggest decentralized stablecoin currently, or one of the biggest. And what it achieves, it's putting a lot as well on the collective work of plenty of people, while vaults are more just managed by one company. So there is a trade-off here when you have the collective of Sky, which I don't know how many companies and how many individual contributors are working on it. You have a decentralized set of governance. Nothing can be done without an on-chain vote. Obviously, that's the drawback, is that it takes more time. It requires more coordination. Also more a spirit in the sense of creating something collaboratively with a lot of people, while Vault on the other side is more, a Steakhouse Vault is created by Steakhouse, and Steakhouse make some decision. It's limited quite a lot, and we give power to the end user to veto what we can do. But at the end of the day, there is still this relation of, we have one counterparty, which is Steakhouse, and if we have a problem, we will contact Steakhouse. So MakerDAO is a bit more different in the sense of Steakhouse might end at some point, but Maker will always continue. It's on chain. There will always be people having some Sky token, and there will always be possible to create a new action. So there is this regulatory immunity in a sense, because you cannot shut down Sky. Sky is something that will last probably forever, at least as long as there is a blockchain. While Steakhouse is a clear counterparty that even if you have no trust or no need of trust on Steakhouse, we have some contractual arrangement with some counterparties. It's a different way of doing the things. I wouldn't say one is better than the others. It really depends on what people are looking for. And for instance, we are creating a vault on USDS. So we are collaborating together from the more collective world or decentralized organization world to the more privately owned corporation that are managing vaults.
Like, they're different, and you have to look at the liability side. So like Seb always says, you have to look at the balance sheet and you have to look at the liability side. And USDS is a stablecoin. So it has network effects and it has a funding cost that's necessary to raise the utility of that stablecoin. And so it's solving for a different thing than a vault, which is much more narrow in its application. Like a prime vault can be used for many different purposes. It's a building block, let's say, where the asset liability management equation for Maker is in the service of the users of USDS as a stablecoin. So those constraints might be different, but they're not all like competitive. They're very much like parts of a whole and often like build on each other.
And maybe to add, the social layer, the flexibility of a Sky is greater because it has a decentralized governance. You cannot pass something malicious because most people will vote against it. So you have less of a need of a cryptographical guarantees because you know there is governance and it will stop anything bad happening because there is so many people, some are good. On a vault business, it's a bit different. You need more cryptographical guarantees. So you have less flexibility because you have only one counterparty. So, and obviously that's why you try to remove any unilateral decision by this counterparty.
It's interesting to reflect on basically the one model, the Sky model, being fully automated in a sense, but then you're saying secured by the social contract. Versus the less automated by comparison vault curation world, which is increasingly secured by the cryptographic angle, which I guess makes sense because ultimately what you're looking to do is kind of provide those guardrails or that overlay to compensate the existing risks that are inherent in the system.
Correct. Yeah, one need to have a vote on everything or most or everything, while on our case we limit the flexibility of the creator, so the small part that the curator has flexibility, it can be put off chain and not requiring a vote of 7 days and endless discussion every time we want to do a reallocation.
Yeah. How do you guys think about where we are now with vault curation and the development of this activity in the space versus where we're likely to go? I mean, it seems like the majority of the strategies now are basically collateralized lending against crypto assets. And I think to a lesser extent, because of the difficulty of using them, to a lesser extent, tokenized assets and RWAs. But ultimately, I mean, presumably the model needs to move to ultimately be able to support real world collateral in order to really scale and to kind of bridge in more of traditional finance. So I wonder how you think about like where we are today, level of maturity of the space, and then how the trajectory is likely to proceed from here.
I think one of the things that Morpho has done well, and I would say like vaults existed before Morpho, but Morpho really catalyzed a new phase of growth because they approached it from a very common sense perspective of thinking that you can decompose individual financial operations into the smallest possible unit and then re-aggregate the liquidity around them in a modular way, instead of trying to build a fully vertically integrated stack of products where you might lose some network effects along the way. Morpho really begins actually at the Morpho Blue singleton with the individual, with the individual borrow lend functionality, and vaults are actually just a construct on top of that. And in order to see broader real world adoption, I think you have to kind of follow that same pattern where you, instead of being tempted into going wholesale into tokenizing a very large and very complicated financial product, in time, what we hope to see is more disaggregation and unbundling of individual financial transactions into sort of atomic and unit level, and then recombining them in a way that's logical for DeFi and that's suitable for this world where stablecoins can travel in vast amounts very quickly. So you mentioned tokenized real world assets. You mentioned vaults. I think there's two things that are interesting to touch on briefly here. One is, are vaults always going to be borrow lend? Following what I mentioned, I think to the degree that we are able to isolate individual financial operations and rebundle them again later, we'll be able to build vaults that are more and more complex. You can already do vaults that execute essentially arbitrary strategies with full discretion from the operator that resemble very much a sort of hedge fund type activity where the user has to seriously trust the operator. What we're trying to do is continue that same trend of non-custodiality, but expand the scope beyond borrow lend. And if you think about it from a financial market structure perspective, it also kind of follows like the building block of most finance is sort of overnight repo. And then on top of overnight repo, you have more operations that are collateralized by the liquidity that changes hands in those markets. And so you can think of it as sort of repo followed by operations that take on slightly more duration. You see very promising first steps with things like Pendle tokens or Morpho's upcoming fixed rate markets, to even complicated things like leverage or carry or things like that. What we're hoping to do is to continue building in that same sort of tradition of non-custodiality, but build in additional elements that expose users to slightly different strategies, and where the user is able to fit more cleanly into one category or another. And I think that's important because, if you stick to the sort of borrow lend construct with Morpho, again, like incentives are a natural law. Like fundamentally, one of the main ways that a curator attracts deposits into their vault is through being able to offer lenders a higher interest rate. And the easiest way to offer a higher interest rate is to onboard riskier collateral, which you saw sort of the consequences of with Stream Finance, where, Elixir, Stream were being onboarded into vaults, into Compound, into a whole bunch of different venues. Because very simply, they were offering a uncompensated level of return for the level of risk that was being onboarded. And so what that had the effect of is you had users who were looking for slightly more risk than prime, mixed in with users that were comfortable lending to borrowers who were speculating with dog shit, frankly. And it would have been better if we had been able to segment the users a little bit more and isolate what we call high yield repo. We really put a lot of focus on underwriting the collateral that we onboard. It's tempting to try and move quick and onboard things rapidly and offer and print the best APR. But in the long term, we think that this is ultimately harmful for users. So we prefer to offer a product that's more robust from a risk perspective, and therefore can offer a better risk adjusted lending return. And for those users that have the appetite for more risk, deliver a product that's equally, as risk underwritten as the repo market side, but simply offer a different dimension of risk. Carry trades, leverage trades, maturity type exposure products, that sort of thing. And then to touch on the real world asset side, a lot of this has been taking place with crypto native collateral, what we would call crypto native collateral. It's always possible to take something issued by a regulated financial institution that's wrapped in a token wrapper, and you onboard it onto Morpho, and then all of a sudden you have a real world asset market. The far more interesting experiments, I think, are things like Daylight, or things like USD AI, that are moving, rather than moving from the real world into crypto, are kind of going in the other direction. And they're obviously still very experimental, but are an example of the type of origination that can take place when you think about things from a DeFi first perspective. Like GPU lending may or may not actually be sustainable. I have no idea. But it's an economic reality that a lot of data centers have a lot of trouble in financing their capex for a surge in demand for GPUs and data center bandwidth. So USD AI in this instance is, for example, meeting a very real economic need by raising balance sheet in DeFi and allocating it into the real world. And then on the other side, from the real world to the crypto world, I feel like the first leg of interest is more around capital accumulation, where traditional finance firms see, oh, there's so much money in DeFi, there's so much money in vaults. Let's just make a vault and put as much AUM into our existing products as we can. But the long-term winners, in our view, are the ones that are going to be thoughtful about it and are going to say, like, what are the inherent advantages of stablecoins to the way that we do business? And how can we make a product that caters to that and can therefore actually succeed in DeFi beyond just a proof of concept?
Thank you. Very insightful. There was news within the past few days of, I think, Bitwise entering the vault curation space. And then there were enough of these kind of like, what's important about 2026, kind of like end of year, reflections. And many of them seem to focus on vaults and scaling AUM in vaults as an important projected trend for 2026. At the same time, like, okay, so you guys currently manage 4 billion across your vaults. Like, it's not like you can move to 40 billion overnight. Like, we're talking about a finite amount of even available collateral assets, not to mention actual demand. How do you think about, how this space is likely to evolve from here? How quickly can it scale, and what would need to happen in order for the next 1 or 2 orders of magnitude to really manifest here?
Yeah, I would say I'm obviously on the side to say that the vault business will grow quite a lot over the next few years. That's why I'm running a vault creator company. But just to point out, it's true that in DeFi, for a long time, there was 100 people wealthy because they made a lot of money early in crypto, and it was the main source of capital. Now, with Coinbase, for instance, then was the first bridge to break or to be built for the image. Then people on the Coinbase platform were able to invest and allocate to DeFi for the first time. So that was a new wave of people. Obviously, since Coinbase started the movement, every fintech is trying to get the same product. I mean, there was Kraken announcing something yesterday. We are speaking with everyone on those topics. So that's moving. So we will have all the centralized exchanges allocating capital into DeFi. Now, what is the next step? Custodian. You have a lot of digital asset treasuries having a lot of assets that are sitting on custodian, regulated custodian, and those will say, well, maybe we should generate a yield on it. They will have to allocate it. And what best way to allocate it than in DeFi? Because every lender or every asset manager like Celsius, BlockFi, all those kind of middlemen or shallow banking, they all blow up. So the only one that didn't add significant losses were DeFi because everything was transparent. Everything was well thought, more or less. So that's why we see the next wave, fintechs, custodian, and then at some point, maybe banks, because a lot of people, you have probably followed the discussion on stablecoin with the Genius Act and now the Clarity Act. Banks are scared that people will migrate to stablecoin. And they made sure that the stablecoin are not allowed to give a yield on MiCA in Europe. And now with Clarity, it might change as well in the US. Now people will want a yield. So instead of just having the native yield of USDC or any other stablecoin, they will allocate it to Vault. And so that will grow the business of Vault. So I would say, obviously not 40 million tomorrow, that will be a journey. But over the next few years, it's not impossible to see this kind of order of magnitude.
And what the vaults prove, I think, is, for a long time, there's been this, part of the anxiety that Seb alludes to from the banking sector about stablecoins is the idea of deposit flights creating a contraction in credit in the real economy. The central banks that are worried about this is generally the thing they're worried about the most. And we feel like it's an overwrought worry, because what vaults prove is that even when you have a system with enforced narrow banking, like with stablecoins, because the rules in Europe and the rules in the US force the stablecoins to be only narrow banks, you can still create a vibrant credit economy on top with a lot of origination taking place, and why not spread into the real world as well. This is for sure a meaningful shot across the bow at the banking sector that has in the US already faced a lot of competition, both from a regulatory blocker and risk capital perspective, but also just inherent competition from a pure innovation standpoint from private credit funds. The same trend, where private credit has started to take an outsized share of loan origination in the US, less in Europe, but increasing and very quickly. And stablecoins are kind of in that trend, in our view, when it comes to ongoing economic or credit activity in the real world. The banks that have the biggest innovators dilemma and the most to lose will have the most resistance, but we're also hopeful that there will be enough incumbents and enough forward-thinking banks that will recognize the value that they can add either as an intermediary or as a loan originator or a service provider to the stablecoin economy. And maybe just to take another step back and reiterate that our long-term direction of travel view is eventually the entire economy will stablecoinize. We think it's such a superior form of moving money in any currency that it will eventually take over. And there's no reason why, a generation of children born today have to have a bank account in 18 years when they could, for example, open a wallet or open a social media app with a wallet balance or something similar and simply participate in the economy that way. And what vaults are doing are sort of preparing the terrain for that.
Firstly, it's a very compelling view around the future of not only this space, but finance as well. And I think, Seb, you make what is probably for you a very obvious point, but I think, for the broader community, perhaps not, which is that, it's kind of easy to think about the crypto financial system as being the sort of sum TVL of all your market cap of all different crypto assets, whatever it might be today, around 3 billion. But actually, we've entered a world now where dollars, euros, yen from fiat bank accounts are basically being moved into wallets, apps, platforms like Coinbase, like Robinhood, and then plugged into DeFi yield, DeFi lending pipelines, so that it doesn't necessarily need to start from a market cap increase of crypto assets and whales getting wealthy and then recycling capital back in. There's actually just a direct path from money at your Chase account into a Steakhouse vault on Coinbase, and then everything else that can flow downstream from there. I think this is a fantastic place to end. Incredible conversation. Very excited about where we go from here, and excited specifically to watch your guys' progress. Adrian and Seb, thank you very much for joining us today.
Thank you very much. It was a pleasure.
Thanks so much.